Good afternoon and welcome to another edition to Rethink Wealth. I'm your host, Kevin Thompson, investment specialist of White Rhino Financial. And today we are here to speak about what's going on in the markets at this present time. Many of you have seen a downdraft in the markets over the past several days. That's not to say that the economics has changed. Economics are still strong. Strong economy, low unemployment, slightly increasing wage growth. We have a lot of things that are positive in our economy. One thing that hasn't been spoken about at length has been bonds. In the fixed income space at this present time, there has been a 30-year bond bull market. What does that mean? Bonds have given people positive returns over the last 30 consecutive years. That has come to an end. Over the last few weeks, you've seen the 10-year yield move from 2.5 to 2.8. The 10-year yield, which is a barometer of all things fixed, has seen a 30 basis point move within the last 30 to 45 business days. That's not necessarily uncommon. However, when bond yields increase, the principal of your account decreases. So I've been getting calls from clients who are wondering why their fixed income portfolio is falling. Traditionally, what you're going to see is that when fixed income moves down, equities traditionally move up. Over the past 30 years, we have enjoyed a correlation in which bonds would move inversely of stocks, or they would move in the same direction of stocks. However, they were there to tamper the overall volatility of the portfolio. Now you're seeing the opposite. Not only are you seeing a reduction in your principal in the portfolio on the fixed income side, you're also seeing a reduction on the equities side. So here's the question you have to ask yourself. If my portfolio from the equity side of it is moving down, and now yields in the fixed income side are moving up, which means my principal is being reduced on the fixed income side, where is the safety in the market? Well, I would say that safety would be in cash. That is not a recommendation to go move your fixed income portfolio to cash, because in some instances, you're getting a higher yield that's going to offset the quote unquote duration risk in your fixed income portfolio. What do I mean by duration? Well, duration basically means that, hey, if my duration is, let's say, an 8, a 1 percentage point increase in interest rate means I have an 8% reduction in my principal value in my fixed income portfolio. How we offset some of that risk is not necessarily intuitive. However, what we do is we make sure that we minimize duration risk by adding in some floating rate securities, by adding in some short duration securities that can bring down our overall duration of our portfolio from, say, an 8 to a 4. Now, if we bring down our portfolio duration to a 4, and we can somehow get a coupon that's greater than 4, we have now basically said, hey, if interest rates move up by 1%, we may lose 4% on the principal side, but we're okay because we're getting a 4% coupon on the bond side. So overall, our total return would be positive in our fixed income portfolio. That's how we offset some of the duration risk we're seeing in our stock market at this present time. Now, in the fixed income space, we are still managing the overall risk. But one thing we'll say is this: if the fixed income space, there's no safety in that world, and there's no safety in the equity space. There's a little bit of safety in cash, but we do know that if we stay in cash, what happens? Inflation beats us. So we're in a market right now that where if the equity markets go down, fixed income prices go down, and inflation starts to increase, there's not a real safe place to put your money because you'll be losing out in all three facets. What our job here is to do is to make sure we educate our clients to help them understand that we need to make sure we stay fully diversified in the markets and outside of the markets. This is a lesson in fixed income. Fixed income is not the safety asset as it used to be. With interest rates being as low as they are, they can do nothing but go up. That's called the reversion to the mean. So if they go up and we have a heavy fixed income portfolio, please be aware that your portfolio will lose value in regards to the principal. We have what we call duration risk, like I mentioned before. And now you've seen what they always talked about and what happened last year, which was a very unusual year, is volatility. Volatility has crept back into our markets. You've seen the VIX, which is the volatility index, move from a 10 handle to a 14 handle in a matter of days. That is not uncommon. You're going to see stretches where the Dow Industrials, like today, which is February 1st, was up 137 points at one point today, and it went negative in intraday trading. That is what we call normal volatility. What you saw last year when the market only saw a 3% downturn is not normal volatility. Normal volatility over the last 37 years has been about 14 handle on a reduction in regards to the equity markets in any given year. That means you should see from peak to trough a 14% reduction of asset prices in any given year. That is normal volatility. What you've seen over the past several years is not normal volatility. What happened several years ago in January when the market was down 12%, that is normal volatility. So our clients have to understand that when the market gyrates like that, that is nothing but more than a normal volatility. We should feel more, uneasy when the market doesn't give you that volatility because you know that it's coming. Thank you so much for joining us today, and we appreciate your time. As always, the information presented is from White Rhino Financial, and any content within should not be deemed as advice. This message has not been approved by Guardian Life, Park Avenue Securities, or White Rhino Financial. If you have any questions, please feel free to contact your financial representative with White Rhino Financial for assistance, and always remember to rethink wealth.